Order flow isn't broken, you're just trading a signal that's already dead by the time you read it. Yeah, I know how that sounds. Give me 6 minutes and I'll show you the one mistake almost nobody on YouTube talks about, and why the insider information every course is selling you literally can't exist in the way they're selling it. 3 years ago, I opened an order flow chart for the first time and thought I'd found a cheat code. Numbers everywhere. Buyers, sellers, delta, imbalances, all of it just telling me where price was going. It wasn't. It took me a while to admit that. So here are 6 mistakes I made, and still see traders make every day, sorted the way they actually show up in real trading. Stick around for the last one. It's the reason you can do everything right and still lose. First one, using order flow as your reason to trade instead of your confirmation to trade. Here's what that looks like. You see aggressive buying. Big green delta. Feels obvious, right? Buyers are in control, so you buy. Except order flow doesn't know where it is. It doesn't know if that aggressive buying is happening at a random price in the middle of nowhere or right into a wall of resistance that's held for 3 sessions. Same signal, completely different outcome. Order flow tells you who's winning the fight right now. It does not tell you if that fight even matters. That's what context, market structure, volume profile, key levels is for. Order flow is the microscope. Context is what tells you where to point it. Next mistake, and it's a satisfying one to make, trying to read every single number on the footprint. It feels thorough, it feels professional, but it's the trading equivalent of trying to follow every single bid at a fast auction. You'll drown before you catch anything useful. What actually matters are the big things, heavy volume clusters, stacked imbalances, the 2 or 3 spots where something obviously significant happened. Everything else is just noise wearing a costume that looks important. If you're staring at every tick, you're not analyzing the market. You're just giving yourself a headache with extra steps. This one trips up almost everyone eventually, myself included. Assuming delta and price always agree. Picture a tug of war. Green candle, but the delta underneath is negative. That's not a bug. That means sellers were actually throwing more volume at the market, and buyers still won the fight anyway. That's not weakness, that's buyers absorbing everything sellers can throw at them and still pushing price up. It's one of the more bullish things you can see, and half the people trading it read it as a reversal signal and short it. Delta divergence usually means absorption, not exhaustion. Follow the candle, not just the color of the number underneath it. Number 4 is the one that sneaks past even careful traders. Treating every footprint like it exists in a vacuum. Say you spot a buying imbalance on your 1-minute chart. Looks great. Now zoom out to the daily volume profile, and that exact same price is sitting in the middle of a low volume zone nobody's cared about in weeks. It's not a signal, it's a coincidence wearing a signal's clothes. Now take that same imbalance and put it at the edge of yesterday's value area, right where big volume actually traded before. Suddenly it's not a coincidence. It's a real reaction at a real level. Same footprint, same numbers. The only thing that changed is whether you bothered to zoom out. That's the entire difference between a trade and a guess. This one's just annoying, chasing a big order on the DOM that vanishes right before price gets there. You've seen this, huge size sitting on the bid. Looks like a wall, price creeps toward it, and it disappears. That's not a glitch. Somebody parked that order there on purpose. To make the market think there's support that isn't real, get people leaning the wrong way, and then pull it. It's basically a store putting up a 90% off sign, and the second you walk up to the register, they take the sign down and go, "Oh, that sale ended." Real liquidity holds its ground when price gets close. Fake liquidity runs. Learn to tell the difference before you trust it with your money. And here's a small one that costs people a surprising amount of money. Placing your stop loss based on a random number of ticks, instead of where your actual trade idea gets proven wrong. If your entire trade is based on buyers absorbing sellers at a level, your stop shouldn't just be 10 ticks below entry, because that number felt right in the moment. It should be right behind that absorption zone, the exact point where your whole reason for being in the trade stops being true. A stop that isn't tied to your idea isn't risk management, it's a guess with a dollar sign on it. Okay, 6 mistakes down, but remember what I said at the start about a signal that's already dead by the time you read it. We're finally there. Every single signal in order flow has an expiration date. I call it alpha decay, and almost nobody explains it this way. A bid-ask imbalance, it's useful for seconds, not minutes, seconds. If you're not already in the trade by the time you finished reading it, you're not trading the signal anymore. You're trading the memory of a signal that already resolved. CVD divergence lasts a bit longer, minutes maybe. But here's the catch. Everyone's charting software shows it now. And the value of any signal drops the moment everyone can see it at the same time you can. Delta on its own can hold up longer, but only if you're reading it with real context, not just glancing at a color and reacting. Most traders are combining fast, short-lived signals with slow human reaction time, and calling that order flow trading. It's not. It's watching a dashboard and guessing with extra confidence. And here's the part that should bother you a little. The big institutions actually moving these markets, they're not leaving their real activity sitting out in the open for you to read. They're using algorithms specifically designed to hide it. What you're actually seeing on your order flow chart is retail and small institutional flow, the stuff too slow or too small to hide itself. So when a course promises you insider access to what the big players are really doing, think about that for a second. If it were actually visible on a retail charting platform, it wouldn't be an edge anymore. It'd just be public information with a subscription fee attached to it. 3 years, 6 mistakes, and one uncomfortable truth. Order flow was never the cheat code I thought it was. It's a lens, a very good one. If you know its limits, its speed, and what it's actually not showing you, which of these 6 is the one you're guilty of? Tell me in the comments. I'll bet it's not just one.